Good morning, everybody, and welcome to the DecisionPoint trading room. My name is Erin Swenlin, and I am here with my father, Carl Swenlin, and we are here to help you get the week started and see what to expect possibly going into the week. I want to let you know, first thing, we are not registered investment advisors, so all trading decisions are your own. Anything you hear in this trading room or read in our blogs, particularly when we talk about buy signals, buy points, sell signals, sell points, just remember those should not be considered calls to action. I think that covers all of our house cleaning, Dad, so I'm going to hand it right over to you so that you could get started with our review. But I do want to tell you, Dad, that you may not know this. I'm sure you don't. I didn't until this morning. But apparently, you're being vindicated a little bit in the fact that Goldman Sachs has now said that the downside risk for the S&P 500 is 3,600 now, or a 50% retracement from the highs of what we heard earlier. And just for those who are watching, Carl's been talking about a 50 to 55% retracement since we topped, I think, in January. So you're finally being recognized, I guess, not by name, but certainly by your thoughts.
Right. Yeah, I should talk about that a little later. Don't let me forget. As far as the downside projection. Okay. Starting out with the market, we have the SPY and S&P 500 are down about a half a percentage point this morning. They broke a fairly important support level there. Really, I'm looking at this level. I'm looking for the June lows to be taken out. Let me get there. That's the big support level right now. And I think they're going to be taken out probably this week. We got climaxes all last week, 3 exhaustion climaxes, and it didn't stop anything. And we keep hearing about how sentiment is so bearish that it's got to be bullish. But I'm here to tell you, sometimes they're right. The surveys are right because it's obvious. Everybody gets it. At some point, everybody will be sitting on the wrong side of the boat and it'll tip. But mainly in a bear market, you get bearish sentiment, and it's right, and it stays right for quite some time.
I would ask that maybe you scroll down and show us the VIX, because that's kind of been my go-to, that, the VIX, when we talk about everybody's so bearish, where are those VIX numbers that would really show us that? Because, granted, it's high right now at about 31, but, we've seen, just this year, back in February and March, those numbers on the VIX were much, much higher readings.
Let's go to this chart.
Oh, excellent.
Yeah, and I got too many pixels on the width, so let me fix that.
Yeah, it's always tricky for us to get the sizing just right for you guys. I know there's still a lot of white space a lot of times, but which does bring me to something we didn't mention. If you are finding that our charts are a little bit blurry, we recommend you might want to try a different browser. That will sometimes correct the problem. And then, of course, make sure that you are on 1080p for your YouTube channel.
Right. Okay, here is almost all the history of the VIX. You notice that on the left side, we've got dots instead of high-low close bars. And that's because this is when they originally released the VIX or set it up back in, I guess it was 2003. They did back calculations of what it would have been if it had been in force at that time. So this gives us a good idea of the range. Now, you can see this back calculation here doesn't have those as high. So you don't get this kind of extreme on the bars. But here, this is the financial crisis, decline, the bear market, and VIX hit its high. And this is a fear meter. It hit its high well before the actual price low. We have the COVID-19 spike, and again, well, that hit just about, looks like almost exactly at the low. And these were two different kinds of bear markets. This one was a panic. The COVID began as a panic. Nobody knew what was going to happen. Really was, is the whole world going to die from this stuff? Nobody knew. Finally, at this point, no, everything's going to be fine, and there goes the bull market. But what I wanted to point out is, okay, after that spike and the bull market resumed, notice that it never got down to this real complacent level. There was a lot of fear involved, but now we've got a decline of about 20% on the S&P 500, and it still hasn't gotten back up to this level of panic, and then here's a more extreme level, but people still aren't scared. So if you want to know a sentiment indicator, this one is for real, in that it shows second to second, I suppose, how people are betting. And the VIX, forgive me if this is too simplistic, but to me, it's just it's a reflection of the premiums being charged on options. And the more fearful the sellers of those options get, the higher the premium goes. So right now, still a lot of complacency. Since I'm off on the tangent here, let me go over to another chart I had prepared for this morning. This is T-bonds, 30-year. And notice this is from a low in 1981 to a high in 2020. Now that's almost 20 years to the high. Notice these were extremes, but breaking out of the channel. But finally, it's breaking down. And I believe we've started a new secular trend of bonds that's just going to go down. And, we'll say this is the target over the next 20, 40 years, whatever. And the reciprocal, of course, is the yield. And you had a downtrend for all those years, and now you've broken out of that, and there you go.
Yep.
One other on I had. This is off the track, but we talked about this last week, Erin. This is ETF, the Global X Super Dividend ETF, a 15.5% yield this time. Now that looks very tempting, but if you look at the weekly chart, and we should look at weekly charts, you should look at them all the time whenever you're contemplating anything, because it gives you the long-term trends. And look, so here it hit its high back in 2018, and it rallied out of the 2020 low, but now it's headed back down again. This is the low, historic low for this. It's only about, let's just look quickly, the monthly chart. So it goes back to 2011, and that 2020 low would be very long-term support. But I do believe, and if you look, let's look at the daily again, you can see we've had for a number of months, the monthly dividend was 10 cents. In September, it dropped to 0.095. Not a lot, but so that makes it closer to 14% than 15.5. And it's in a a free fall at this point.
Mm.
But one to keep your eye on, and I'm not recommending it without reservations, because you need to look into it more, and you never put too much into one position.
Yeah, and at this point, it certainly could continue downward, but definitely watch list material, because really when we start coming out of that, the bear market, this could be a really good place to move into, just because you're going to get that dividend.
Yeah, at the very least, you want to go in on the internet, look it up, and look at the holdings it has, and make a decision on that based on that. Because let's face it, if the prices keep going down, it's probably a forecast of what yield is going to do. The earnings, they don't show it, of course, on a ETF, but the earnings of these companies is going to drop, and we don't know how much, but that's a factor in there. Okay, let me get back to the market. I wanted to look at, yes, this is my view. If I had a choice of only a few indicators, these would be in that list. The STO, Swenlin trading oscillator for breadth and volume, and that hit an oversold level on Friday. I expect it's going to go, based on what we see on the market doing, it's probably going to go lower today. ITBM is heading lower. It's certainly equal to these oversold levels, and there you would look for a bounce, as you would with this getting oversold. Let's look at the dollar. It's still strong and against other currencies, and that's not good for gold. So
Before you leave that dollar chart, we did get an email question about it. And I know this isn't really what you like to do, but they were talking about entries and exits on UUP. And, the question, of course, will become is it too overbought? You can see sort of that short-term parabolic that started up. I don't know that it's too late, but what I would be looking for certainly would be a pullback, because it's not going to go up forever. And this is an awfully, it's just been accelerating pretty quickly here.
Let's go to the weekly. Yeah, it's parabolic now. So it's probably not a good time. We don't know how the higher parabolic will go, but it's right now, you've got to be sitting there watching it every second. And so, no, wouldn't think down around here would be a good entry point.
Well, of course.
Too late.
But I mean, you can see some of those pullbacks, on that. And so to me, it's like, we more than likely are going to get that pullback toward, the 30, 29, 50 area, just, as a regular pullback, but yeah, I wouldn't be looking to get in now. And honestly, I mean, it certainly could go much higher. But as I often say to my kids too, I think there are better choices that we can make right here.
Right. Yeah. Right now, if it does pull back, it might pull back to this line. But right now, I would be drawing a line up this way, because, which increases the rate of ascent. And so, no, it's definitely not a good buy at this point. And gold is not happy camper. And let's look at the weekly on gold. It's very, very bad news. This rising trend line is broken. This support has been broken. And the next support here is around 1530 was, no, I'm sorry, it's 1570 roughly.
Yeah, with the dollar sailing, it's
Right.
just those headwinds are just ridiculous. So,
Yeah, and it's affecting commodities.
mhm.
And so same with the crude oil breaking down through this support. So this is the next line of support that we would look for it to stop. Then we have treasuries, 20-year treasuries, and they're going down, but we looked at the long-term chart. There will be some bounces, but the long-term trend on treasury bonds is down. Bitcoin found nice support at this level, which is about 18, I think. Yeah, well, here you go. About 1825. I'm sorry, 18,250. Ultimately, much lower, in my opinion. Here's the yield on the 10-year, and that's headed higher as we would expect, and yields are going to be higher over the long term. Let me see if I forgot anything in here. Yeah, I did. The one bias assessment. I'm going to make a statement. I think the Silver Cross Index and the Golden Cross Index are the best breadth indicators ever. Okay, I'm ready to be a call on that, but I don't think there's any breadth indicator out there that's more specific. And the Silver Cross, that means that's the percentage of stocks with the 20 EMA above the 50 EMA. And as you can see that on the 500, the S&P 500 chart, and that was just SPY. And this tells you, it doesn't tell you if the fastest is turned back up and it may be ready to cross back through, but it just tells you very specifically, you've got only 27% of the stocks in the S&P 500 have a 20 above the 50 EMA. That's pathetic.
Yeah, it's terrible.
The Golden Cross is the percentage of stocks in the S&P 500 with the 50 above the 200 EMA. That's the 35%. And
again, it's turned down, and
right, if you cross back through the signal line, and it's going to get a lot worse before it gets better.
Yeah, and again, another sign that, yes, we're oversold, but even this year we had much lower readings on both of them.
Right. And this is, if I had to be limited to two charts, this would be one of them. And the other was the ITBM and STO chart. Mm-hmm. To me, you can go a long way with these, and these will keep your head in the right spot. We're going to talk about the long-term view for the downside. And I'm trying to remember where I put the chart that I want to.
Right. So for those who are joining this just a little late, I did tell my dad about the fact that Goldman Sachs has now finally said that, the downside risk and, what they're thinking could be a possibility is a 50% retracement from the highs, the all-time highs for the S&P. And as I mentioned, Carl's been saying this for, certainly all this year, that was a likely scenario. And most people, and we even got an email a couple of weeks ago, what does that mean? Like how far, what do you base that on? And with that, I'll hand it over to you.
Right. Okay. First of all, we look at history, and here's the dot-com bubble breaking. That was down about 50%. Here's the real estate bubble breaking. That was down about 50%. Here we have bubbles in real estate, commodities. Looking at my list, yeah. Equities, bonds, and housing, and they're all there together, and it's coming unwound. So I would expect a 50% decline from that level. Just looking at history and the way things get so out of whack, they got to be brought back to normal, and sometimes they overshoot in the other direction. But right now, we're down about 23%, and then if we go down to this level, and I believe somebody called this level earlier today, I can't remember where I saw it, but this is a 47% decline if we get below these, down to around these bottoms here. To me, this is the most logical next spot, which is 55% above this congestion here. And below it would be another spot. That's at 59%. Getting down to these tops, which is very long-term support, and people were going to be jumping out of windows by then. And that's about 68% decline from the all-time high. So now, if you look at in terms of the PE range, this is overvalued, and the red lines, the red dotted line, this is fair value, and this is undervalued. We expect that if we get down to the undervalued level, that would be a 59% decline. And I expect before the decline is over, we're going to be somewhere in this range between fair and undervalued.
It's not a pretty picture.
Huh?
It's not a pretty picture. I think you were just getting ready to say that.
Yeah, I don't have a crystal ball, but I'm just saying this is just based on the normal range, and it really hasn't been in the normal range of between overvalue and undervalue for a long time. And the last time it was undervalued, it's not even on this chart. It's 1984. So it's got a lot of educating to do. I think if we had twice the number of stocks in the stock market, we wouldn't have so many people piling into the limited number we have and pushing those prices up. Right now, people are getting out.
Well, it's a reminder. I remember when we started to have that pandemic, and I'm not going to put you on the spot to find the chart, but you would set up a chart for like between 1928 and I think 1933 or somewhere in there. And, everybody talks about the 1929 crash, but what they don't talk to you about is the recovery that came after, and then the incredible breakdown and second bear market, if you will, that came in, just a year and a half, year later off of that, even though we had recovered by quite a bit. So it was one of those things, this is really great, but we do have historical precedents as to what can possibly happen here.
You're right. Based on my ultimately reliable memory, from the 29 top to the 32 bottom, there were 20% moves in one way or the other, 20% defining a new bear market or bull market. So it switched from bear market to bull market. There were 15 bear markets and 8 bear markets and 7 bull markets. And
all in that short period of time.
Right. So it could get way more volatile than what we're seeing.
Excellent.
Yeah. And I think you should take it.
I know. I gave you the full half hour here. Let me get to my screen. And we're going to talk about the sectors and the industry groups and see what's going on there. So obviously, you know, we've had trouble with all of the sectors. We are not looking at anything that is really showing any kind of internal strength or leadership at this point. You know, every time we seem to get something up there, it falls off the top of that list, energy being the prime example, and utilities as well, which are starting to see some deterioration and some moves back down to the downside. And these guys were the leadership roles. Discretionary kind of came out of the woodwork here, which is honestly a little bit for me doesn't make a whole lot of sense that discretionary income would now see a lot of action as far as the companies that are in the discretionary sector, from everything from travel to clothes and shoes. And, you know, when we talk about being in an inflationary environment, I don't necessarily think about people having discretionary income and spending it. So it's kind of interesting that's been near the top. But look at today, we have the two that are completely opposite of each other, really, when you think about it. We have discretionary, which is leading only by, you know, a couple of tenths or 0.1%, really, and consumer staples, which is the opposite. As I said, these are the things that people actually need. You know, the toothpaste and, you know, house cleaners, toilet paper, those sorts of things. So to see the two of them up at the top is actually kind of interesting, this dichotomy between the two. But let's go and look at them a little more closely. And I'm going to use the sector summary here and the candle glance. Now, I was asked, and I talked about it last week, that I do have a particular candle glance and it has my PMO on it. And really, if you want to set up your own candle glance to look however you want with whatever indicators you want, set up that chart style. And all you have to do is save it as sector summary. No, candle glance. It's just all of a sudden it flipped out of my head. Candle glance. So save that chart style as candle glance, one word, and then you will have your style show up every time you do a candle glance chart. And I'm happy to send you that chart style for yourself if you want it to look exactly like mine. Just send me an email to support@decisionpoint.com. All right. So as you can see, when we look at this candle glance, the first one over here is the S&P, but the rest are the, you know, the sectors in the market. And the first thing that should really pop out at you is the fact that none of them have positive momentum. And the crazy thing is they haven't had positive momentum for weeks. And that is highly unusual to see pretty much all of the sectors in a downtrend with momentum falling a great deal. Now, there are other things that you should notice on this chart. First of all, the fact that all of these PMOs are below the zero line, another indication that we have extreme internal weakness right now within the market. I mean, we finally got utilities, which have, you know, shown the leadership role and moving below that zero line for the PMO. I look at this and the majority of these have lost major support. I would say the only ones that have some support really left would be discretionary, because we haven't seen those lows being hit as we're seeing on the S&P, which they're getting ready to test those lows, and discretionary isn't doing that. Comm services, we've already seen the breakdown. If you look at XLK, we are just about to see that breakdown, which again makes total sense. Technology generally is a mirror of what is going on in the broad markets in general. And this one here, industrials, we still haven't quite lost that support level. But again, all of these are sitting where the S&P is. We don't feel very confident about the S&P holding this level. So more than likely, these sectors are not going to either. Materials already breaking down. More than likely, a lot of this is due to the metals, gold having issues right now. That's not good. And then we're seeing some of those Cinderella stocks earlier in the war with the specialty chemicals and those types of industry groups. They're in there and they're starting to fail because things got really overvalued. So in energy, when you look at that, this is one of the first ones here, or the last ones to get their PMO below the zero line. We do still have support here for price, but again, losing the 200-day EMA, just like utilities are today. And again, these were the stronger of the sectors, and they're really breaking down right now. And, I always talk to you, Dad, about it, but, pockets of strength. I'm always looking for pockets of strength within the industry groups and the sectors. Right now, the sectors, none of them are really showing a pocket of strength that I can see as far as the sector itself goes, but we have to still dive in and see, are there any areas where we are actually seeing some positive momentum? So that's where I'm going to go right now. And we're going to go to the dashboard here. And for those of you who are free members of StockCharts.com, you should be able to go to that charts and tools page, and you can have access to that sector summary I just showed you, and to the industry summary, which is what we're going to look at right now. So in each sector, of course, it's made up of different industries, and StockCharts really has it set up nicely where you can just kind of arrow right on through them and see what's going on. I don't want to spend too much time on every industry group and every sector, but I wanted to look at consumer discretionary, and there are a lot of them, so we'll go through them fairly quickly. But since this is one of the few that are starting to see, have seen some positive action, and really on the RRG charts, the relative rotation graphs, XLY is really looking, decent. I won't say good, because none of them, as we just saw, are looking good. So where might there be strength within consumer discretionary? I'm going to click through. If you want your chart to look like mine, you can ask me for the chart style. But if you just want to set up whatever you like for the industry summary, set it up, and then just name the chart style industry summary with the space in there, just industry summary. And you will save that chart style. It'll show up every time you come on to this particular page on the StockCharts website. So auto parts, what we're going to look at right here is the PMO primarily, and then we will go down and look at stochastics and see if they're bottoming, moving upward. And then, of course, right here, I have that industry group and its strength, relative strength to the S&P. So as you can see, auto parts, not a place to be, relative strength failing. Yes, stochastics look like they're turning up, but we'll have to watch the support line here for auto parts, but it doesn't look like a pocket of strength to me. We got a triple double top here settling in. Certainly this top wasn't below the signal line, but it practically was. And you can see stochastics falling. Auto's not looking good. Sorry, I'm used to talking all the time, but my voice isn't there right now. So anyway, we already have the breakdown here in business training. No reason to look at that any more closely. Double top on the gambling. We are seeing a move to the upside of 2.85%. But if we look at this chart, you can see that we have a long wick on this candlestick, currently 458.60. And the low is 458.28. We are trading at the lows for the day. So even though we moved to the top here, we're way down here. And when you see those long wicks on candlesticks, typically that is a bad sign because the bears are winning. So you have them pulling price back down, even though you've had it rising or you're up almost 3%. You have to keep in mind the fact that bears did kind of wrestle the reins out of their hands. Okay, apparently closed captioning has been enabled. I just got a little thing to tell me that. Okay, back to the industry summary. Clothing and accessories holding support barely. Looks like it really broke down. Nothing good there. So really the question is, this is a sector that's been leading as of late, but they're really within it. not any clear pockets of strength. Furnishings breaking down further after losing support. Footwear breaking down after losing support. Home construction, this has been a really rough area. It hasn't come down to those June lows like what we're seeing on all these others. It is testing the support level, but what we know already, and my dad wrote a great article about it on Friday, is the fact that the home mortgage rates are going so quickly higher that it's bound to bring housing prices down. It already is, and new homes are going to really feel that crunch. Durable goods, again, I'm not seeing any PMOs rising. Hotels, none of these really look that good. So when you're talking about, oh, this is a sector that's leading, this one has the most strength, people are rotating here, I just don't see it when I look at these industry groups. Sure, we have some that haven't lost their support, their price support, but the majority of these there's nothing with rising PMOs, just nothing there. Not even stochastics looking anywhere good. So, this is just one more piece of information that there really aren't any of those pockets of strength. Here's consumer staples, which I would have expected to do very well as we've headed lower, and it's just being hit like everybody else. Non-durable household products looking a little interesting, flattening PMO, but nothing I would be ready to jump into. Soft drinks, none of this. I mean, I just don't see anything here. If any of you have an industry group you'd like me to dive into, feel free to put that in the Q&A. But I think we've gone through enough of this, and I think that will leave us about 20 minutes for some symbol requests. As I get my screen set up and Carl gets some symbol requests ready, I just want to go over the process here really quickly. So I'm going to have the daily chart on the left, and then I'm going to have, well, it's not here right now. Let's get that there. And then what I'm going to do is put the 5-minute candlestick on the right. The 5-minute candlestick is strictly for your entries and exits. I don't use it to determine whether I want to be in or out of a stock. I use it to determine when to get into the stock. So the daily chart will be on the left. That'll tell me what I want, if I want the stock or not. I will read this, and then if I like the stock or I really don't like it and I want to sell, then I'm going to go to that 5-minute chart and see when my timing would be best. The conservative entries are a PMO crossover to the upside with a positive RSI. The sell points are determined by a PMO on the 5-minute chart that is turning over. That would be considered a sell point. All right.
Okay.
Gone through that. So let's go ahead and get it started.
All right. Let me, there were a couple of questions that I'd like to.
Those are always more important.
Yeah. Let's see. And I'm trying to find that. I got lost here. Okay. The one person wanted to know, what PE do I use? Trailing PE or forward? I never use forward PE. I always use trailing. Just it's less complicated, and it's not dreaming about what might happen. There's one here. Okay. Erin, you have been right with your market bearish calls. I am curious the reason for not being more exposed on the bear side.
Oh, that's a great question. Number one is I'm not one to short. It's not something I like to do, even in this market. I mean, your downside on a short is limited. The stock is not going to go to zero. There's only so much I'm going to get on the downside. So I tend to stay away from using shorts. What I will use are inverse ETFs as a hedge, but I use them as hedges. I don't use them as primary investment tools. It's just the way I look at things. I prefer just to not be exposed, particularly when there's a lot of volatility like we're seeing now. But for those of you who do have a subscription to DP Diamonds, I do stock picks there. So I still am throwing stuff out there on the buy side. but I'm also showing a lot of inverse ETFs right now that I like. In particular, some of those hedging opportunities, but most of that I do save for my subscribers of DecisionPoint diamonds. But in a general sense, I don't like to short, and I don't think it's particularly smart. I guess, I don't know that that's the right word. I think it's just awfully risky to be investing simply in inverse ETFs. And, Dad, we've talked about it, I think, briefly, but they are coming up with these ETFs that are single stock ETFs. For example, SARK, which is, it's not single stock, but it's a single ETF that it follows. It's the short of Kathy Wood's ARK fund. And, we're seeing some, I don't know the symbol offhand, but there's an inverse ETF for Apple. Certainly these are a different way to play on the short side. I'm hesitant to do that. I need to do more research as to whether that's something I want to do versus shorting the stock in the first place. But it's an interesting thing, but just be really careful. Keeping your exposure low is really the safest you can do. So that's kind of where I'm at. I'm also, I'm at an advanced stage, but I do still have some time left, right on the other end. And I prefer not to get really risky. I need to preserve capital, maybe more so than those out there that are younger than myself.
Okay. What backers you consider for buying long-term? And I will begin with low PE and large, a large cap, blue chip stocks, and look for the trend to be moving up on the stock first and actually on the market first. But if you think the market is near a bottom and the stock itself is heading up, is starting to trend upward, then that would be another good factor. And if you have nothing to add, I'm not saying you don't.
Oh, I do. I'm always ready to talk, but I will do that as we go through these symbol requests.
Okay. ARQT.
Okay. Biotech. So this is a place that a lot of people are moving toward because it's not very homogenous, the biotechs. There are a lot of small up and comers that are super volatile, super low priced. They're your big, the bigger ones, the larger cap ones that are out there. But I know this is an area a lot of people are looking at. This one, I do like the look of the double bottom that might be forming, but this bottom is brand new based on trading today. And let's face it, trading could move the other direction for it. But what I'm looking for as an entry on a stock, I want a positive RSI. That's probably not as important, but the key is the PMO. I will not buy a stock or ETF if the PMO is not rising, period. That's my number one threshold, is the PMO needs to be rising. Why expose yourself to the risk of negative momentum? There's no reason to do that. There are stocks, well, not so much now, but there usually are a lot of stocks to choose from that have rising momentum. That's number one for me. Number two is RSI. Number three would be the stochastics. I want to see them at a minimum rising. Preferably, I want them above 80. That's really the best part, because when they start to oscillate above 80, typically that's going to be, internal strength. It's usually moving up. That's what you want to see there. And then the last thing that I do pay attention to the OBV. Don't get me wrong. I'm usually looking at that just right out of the gates for positive divergences, not confirmations, and negative divergences. I do look at the industry. Relative strength is very important to me as well. I want to see something that's performing relatively well. And a stock's price is 50% related to its sector and industry group. So I want to be in a sector that's showing relative strength. I would like to be in a industry group that is showing relative strength. And then I want to compare the stock to the S&P. And then the really interesting one is to compare the stock to its industry group. Is it performing very well against the group. So those are the key things that I'm looking for. And not all of those are going that way. In fact, the only thing really working in this particular trade would be the fact that the stochastics are moving up and it's in an industry group that is doing fairly well. But against the industry group, it's kind of meh. And against the SPY, it's not that great. And let's face it, with the SPY moving where it is, you have to seriously outperform the SPY to do anything, outperforming it, you could just be moving down a little bit lower at the same time. But I'm not a fan of this one. It does look like it's developing. I could see this on a watch list, waiting for the PMO to turn up, but ultimately just be really careful in the biotechs. And I'm not going to go to the 5-minute because this isn't one that I'd be like, yeah, let's jump in. So no point in getting people to be looking at me saying, oh, this looks good and you should buy it, which I don't do.
SBUX.
Bravo. Okay. Double top forming here. Lost the 50-day EMA. Yes, we're seeing a little bit of a turn. I do like the fact it's trying to bottom below the first bottom that it had. But again, PMO moving lower. Not something I'm going to buy. I hate to do that. You can still throw those requests in, but I will tell you that I wouldn't buy it because just for that point. But look at the rest of these indicators. They're still very, very negative. And in fact, Starbucks is an underperformer right now, just within a group that is it has been doing well, but now it's kind of traveling in line with the S&P. And again, stochastics falling. I don't like this, certainly on the buy side. And to be honest, I'm not really on the short side here too, because it does look like it's trying to bottom.
Okay. Yeah. The question also included question regarding the relationship of this simple moving averages. And we don't use simple moving averages. We use, because they're not predictable, we use exponential moving averages. And, but he is pointing out that it's a nice cup with handle formation. And I'd have to say, yeah, there is that. But the whole thing is that the market is currently going down. And my opinion, is not a good time to buy anything long.
Yeah. That's why everybody's saying, well, why is your exposure so low?
Right.
This is why.
And my question, why is it so high?
I know. I remember at one point I had a 40% exposure. And I think you texted me. I don't know if you even emailed me it with like exclamation points, like what, 40%? But at the same time, when I marked that, I think I had about at least 15% of that was hedge. So ultimately, when you look at it, my exposure was much lower than that.
Okay, Pfizer, PFE.
Okay.
We need to slam some
through here.
Right.
Okay, lost support, PMO still in decline. I like stochastics moving up, but this price support lost, and the fact that it's still moving lower, there's no breakout of the declining trend. Look at its performance against a group that's performing fairly well. Definitely not liking this one. If you're looking at some of these and you want to short them, be sure that you put that in the Q&A so I know that I can talk to you about that. I think this one does have potential as a short simply because it's lost some major support back here. And there isn't really, I don't see the opportunity to find support, at least on a daily chart. So those are the kind of things that I'm looking for in a short. Lost that support, next levels here. So what's your potential on a short is about 8.5% until you get to the next level of support, maybe 10. It's just not attractive enough to me.
Right. PINS.
Pinterest. Indeed. All right. I have to say, this looks a little bit healthier than some of the others, just as far as the price goes. But I bet you if we were to annotate this, Dad, that would be a rising wedge. My eyes are, not great, but I think that might be the case. I'll just pull up the annotate tool. I promise not to spend too much time. Dad keeps me on task, just like when I was a kid. Okay. So yeah, if I drag this down here, you can see that it's a little bit steeper rising trend. So rising wedge, that's negative. It's testing the bottom. So far, it's holding that rising trend. But given the way that the PMO and stochastics and relative strength, I mean, again, not something I'd be looking at on the buy side for sure.
UNH.
UNH. All right, guys, hopefully I find one where I want to show you that 5-minute chart, but so far not really. Now this one's interesting. Instead of a wick, like we were talking about, it has a long tail. That's good. That makes a hammer formation. Those usually will occur on a reversal in the very short term. You can see one back here, kind of a hammer look, because it tells you that the bulls are now taking control. But as far as the stock itself goes, let's see, it's got this support level. It's trying to hold. I don't think it will hold it. There are some redeeming qualities here. We do see that the relative strength for the industry group, and look at what it's doing against the S&P. That's pretty good. But again, it's been outperforming. The group has been outperforming. But what's been happening? It's trending lower. So outperformance here isn't really helpful. And we are losing this level of support. Not liking this one. Maybe you're going to get the bounce off the 200, but RSI negative. Not there for me, guys. So far we're not hitting any.
Okay. Let's see. Someone asked me a question about VIX with the VOLQ. I don't have any knowledge of that, so I can't respond. Sorry.
Yeah. We do have a bunch of VIXs. I don't know if that's maybe what they're.
No. Let's move to the next.
Yeah. Okay.
PBF.
PBF, energy stock, exploration and production. Okay, so we've got the bounce off the 200. We're seeing a rising RSI. I'm not liking that PMO. Let me get to the thumbnail on here really quick. Yeah, that's kind of a top beneath the signal line, but this one is showing some promise, bouncing off the 200, bouncing off this price support, stochastics rising. Certainly it's an outperformer against its group. It's doing okay here, but energy is still really soft as far as a group goes and a sector goes. I like that it's bouncing off of this price level and the 200-day. I think that's great, but it's not getting above the 20 and 50. There's some potential here, but I would still be looking at this as watch list material until I saw oil start to break out, and we're not seeing that.
Okay, XBI and IBB. I think those are both biotech, right?
They both are the ETF for biotechs. There we go. So my eyes are telling me this is the last level of fairly strong support. You can see a touch here, a touch there, a touch there, a little bit of a touch there, and we've lost it. The more touches you have on a trend line or a support or resistance line, the stronger it is. So this is a strong line of support that has been lost. Where's the next one? Pretty close, right down here. So what is your downside risk here is about 3% till we get to the next level. So I would say more than likely you're going to lose at least 3% before you even have the opportunity for this one to reverse, and it's not reversing. Stochastics trying to turn up, but nothing great. I mean, the PMO is super ugly here. I mean, the biotechs as a whole are not doing well, but that, like I said, is one of those weird groups where they're not very homogeneous. So you can find pockets of strength within the biotechs, but it's just really hard because you have to be very careful. They're very, very volatile in most cases. But I'm sorry, I'm not liking it.
Tesla.
And I can tell you this one is on my radar simply because it is near this support level. But that industry group, if you remember, autos, I think was like the first one we looked at. it's failing. And you can see Tesla looks exactly like the auto industry group. I wonder why. It's probably the largest holding in that industry group. And, there's potential here, but we don't really have enough of it for me to risk it. With this possible triple double top for sure, and it's testing confirmation. The next support level, this is still kind of light support because it only really gets a touch back here. This is where you've got the stronger support here, a bunch of touches here, over there. And so again, there's still a lot of downside risk here. We don't have the reversal. I think you're at risk for about a 9% decline just from where we're at now. If I had it, I would hold it simply because it hasn't broken this level of support, but I'd have a really tight stop very close to that level.
Okay, Apple.
I feel bad we haven't gone to that the 5 minute chart, but we're getting through a lot of symbols, and I think that's the most important, honestly, right now. So RSI negative again, PMO. Maybe there's a little tiny deceleration showing up there.
Looks like a short-term double bottom.
It does, exactly. And so there is some possibility here. It is holding a little bit of this support level.
It's actually up on the down day, so that's positive.
That's positive as well. But, the foundation on this one is a little weak. I don't know that I would be buying here. I think that this one is definitely watch list material. We've talked about the market. It's ready for a reversal. Not looking like we're going to get it just yet, but this one leads the market. And if we start to see that market perk up a little bit with price being on this support level, I think Apple could be really interesting. I think getting in now is a little bit dangerous simply because these indicators haven't really firmed up yet, but certainly it is an outperformer. If you want to get in and risk it in this market, at least being with an outperformer, you have a better shot. So, and with that, oh my gosh, we have to close this down. Let me stop the share. We really love having you guys here. We particularly love having you here live. If you'd like to attend live, the YouTube video will have the link to join the live trading room. We do air it at 9 a.m. Pacific time, noon Eastern. So you can be here live and get your symbol requests in. Or if you go to our website, DecisionPoint.com, you can find the link right there on the homepage to click and get into this. We also recommend that you sign up for our free email list, and you can learn much more about what we do on DecisionPoint.com. And let's go ahead, Dad. We'll say goodbye and good luck and good trading.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.